About one of my favorite subjects, and that's how to finance real estate, how to buy, sell, and trade, and do all those kind of things. Now, probably sometime in your life, you thought, well, I ought to buy that. Well, I wonder how much it would take to buy that. What do I have to do uh, to be in that business? And so today we're going to just have a little talk about notes and deeds of trust and tenants, toilets, and trash. And it's kind of a two-pronged broadcast. And I'm going to talk about promissory notes, deeds of trust, and owner financing in one scenario. And the other, of course, will be dwelling a little bit on how to buy property with notes and deeds of trust. And so one part of it is you actually financing the property for somebody if you're a seller or you're a note buyer or you're a note trader, or if you're an investor and you're investing in property and you want to buy with owner financing. So it's kind of quite a bit of moving parts. But let's talk about one thing. You see on my screen, I've got, it says, these are notes. Now, if you look at a dollar bill, I'm going to hold this dollar bill up, and you look at that dollar bill, well, right on the front of it, it says this note is legal tender. And so cash is a note. It's a promise to pay, and it's backed by the integrity of the United States government, not backed by gold anymore. And the promissory note is a document that you sign that says, I promise to pay to the order of, just about like what it says on the note that's cash. And then you've got the counter checks that you see there. And a lot of us are kind of getting away from signing checks now and writing checks, but we usually pay our bills by check. Send a check in, 2 or 3 days later, it is paid through that account. And that is backed by your account. And the credit card. We all use credit cards nowadays, and that is a promise to pay. If you don't pay your credit card bill, they're going to come after you. And all of these have that promise to pay, and they're backed by something. And so let's look at how that works. The form of the note, we just talked about that. And who is the lender? The lender we think about is mostly being conventional banks, small banks, large banks. We think about FHA, which is an insurer. They insure the lender that they will not lose their money. And so you got VA and FHA and HUD, and these people are primarily insurers. Sometimes they're a direct lender, but not very often. And so they guarantee the funds to the bank. And when you sign a promissory note at the bank, if you're buying a piece of property, usually if it's owner occupied, it's FHA, VA, or HUD. If it's commercial, it's usually some other form of lender, like a conventional bank or a insurance company or something like that. But who is the lender? And so this is for us small investors. Why not you? Why don't you be the lender? I'm sure that a lot of people watching this broadcast are financing a piece of property for someone. You might have inherited a piece of property and you've got this and you're sold it and you're carrying the paper and you're getting monthly payments. Or you might have sold your house to an investor and the investor is paying you monthly for that house or that piece of land or that building. So you can be the owner. And let's look at the process. The process, think of yourself as being the lender or the buyer using a promissory note and the lender, and talk about, contrast yourself with the lender being the bank. As you can see on my chart that I've got this guy down here and he's got a bunch of cash and he would like to buy the house in the corner over there. And so he takes his down payment to the bank. The bank will qualify him for a mortgage, and then he will sign a note to the bank. Oh, and this much money I promise to pay to the holder of this note $100,000 at 4% interest and due and payable in 20 years, something like that. So you will sign the note and you will sign the deed of trust. And the deed of trust is a lien against this house, and that lien is security for the bank being paid back their money. And then this fella, he will get the deed to the house, and the seller will get cash. And so that's called cash to new loan. And that's where most all people work nowadays, in that cash to new loan, because there's a lot of lenders out there, a lot of very good lenders, and rates are really at their low point. And it's pretty easy to get a loan if you have a reasonable credit score. So you notice that I've replaced the bank with the owner. Same process, exactly the same process. Somebody's got a down payment, they bring it to the owner. The owner fills out a note and deed of trust, and the buyer signs the note and the deed of trust. And the deed of trust is recorded at the courthouse, and the owner keeps the note. Same with the bank. The bank keeps the note. They file the deed of trust at the public trustee, and then the owner and the bank have a security interest in this house. And in other words, there's a lien against it. And the person with the down payment, they get the deed to the property, and we call that owner financing or seller financing. So the process with the bank and the process with the owner is exactly the same. So you want to buy a house and you've got a small down payment, start looking for those people that would owner finance their property. And that is a very good way to do it. The exact same thing you would do at the bank, with less qualifying, less paperwork, less points, less fees. And so there's just a lot of benefits to doing it with the owner. In fact, if you get in trouble someday and you get a little bit behind, the owner is a whole lot more forgiving than the lender, the bank. And so that's something to keep in mind. I try to do all of mine through owner financing. So the owner or the private lender, this could be the owner of the property, this could be a hard money lender, this could be a private lender, anybody that's got the funds, they will get a note and deed of trust with a security interest in the house. The guy with the down payment will get the property, a deed to the property, and the owner is now the note holder. And it doesn't matter if the note holder is the bank or the note holder is you or somebody else. So what can you do with that note? People tell me a lot, I don't want a note. I don't want monthly payments. I want cash so I can go buy what I want. But look at it this way. A note is an investment. It's an annuity. It pays you monthly payments with an interest rate. You can sell the note for cash. You can sell a number of payments if you need to raise cash. You could use the note as a down payment to buy a larger property. You might pledge that note as collateral, hypothecate it so that you can get enough money for a down payment on something else, and you still got your note payments coming in. You could include the note in a 1031 tax-deferred exchange. You could trade the note, or you could just enjoy the income. So that's a whole lot of things. Practically anything you can do with property, you can do with note. Now, we buy notes, and I have investors that buy notes. And these notes, you can convert them to cash, and that would be by selling your note. And you might want to sell your note to generate cash because you don't want to finance the property anymore. You can also create notes. If you own a building or a house that's free and clear, or got a small mortgage against it, and you can make the payments, you can create a note against that property, and then you can take that note to the marketplace and use that as a down payment or the price of the property. You can buy and sell a partial. You can buy and sell 20 payments out of that note. You can buy and sell 5 years worth of payments. So, but all this comes, it's an investment, and people are looking for a rate of return. When you buy a piece of property, you're looking for a rate of return. You're trying to make money on your investment. If you own property, then you've got, as the title said, tenants, toilets, and trash. But you can use owner financing to buy property. And then you maintain the property, you deal with the tenants, you deal with keeping the place up, and you deal with all the things that come along with property management. But on the other side of the property is the lender. So if you are the lender and you loan money on a piece of property, or you finance a piece of property that you own, then you are just like the lender at the bank or FHA or VA. You are the lender, and you're getting those monthly payments. And the great thing about that is you get a very good rate of return, and you got monthly payments coming in every month, and nobody calls you up and say, hey, the dishwasher broke, or hey, the trash hadn't been picked up in a month, or hey, the water bill is too expensive. I don't want to water the grass. You don't have any of those problems. They don't call the lender and say, hey, I've got a problem with this property. So you can buy the property using owner financing, and you can also buy the note that is financing that property. For now, in our period in life, we would rather buy the note that is financing the property. So there's a whole lot you can do with a note. So if you want to sell your note, give me a call. My information's on the screen, info@montrosecommercial.com, and I respond almost immediately. We buy notes, and we sell notes, and we create notes. So if you've got something to sell or you want to talk about, then get a hold of me. So I get a question all the time: what's it worth? Well, that depends. Depends on a lot of things. Just like the lender, you have to do your due diligence. So the value of the note and the value of the property depends on the maintenance, the upkeep, the quality of the property, the location, the quality of the tenants, the payment history. All of that comes into play. So if you got a promissory note to sell, and you got a poor property and you got a poor payment history, then that note is probably not going to be worth a whole lot more than something else that has a good payment history, a good property, and a good location. So that's why it depends. So if you've got a question about a note, if I know the address of the property and I know I've got the note, a copy, then I can look at it and I can make a pretty close determination. So what's it worth? It depends. So this is another one altogether, another broadcast. So I'm going to end this broadcast and look it over and see what I think about it.